Amazon is spending $105 billion in the next year, and it could flow into these 5 stocks, the billion-dollar buy signal that could mean triple-digit returns. Hey Bowtie Nation, Joseph Hogue here with what could be the biggest investing story of the year, the hundreds of billions of dollars in spending by hyperscalers like Amazon. I'm going to highlight the 5 stocks that could see the biggest share of that $105 billion bonanza, including one that Amazon could buy outright. Keeping up with other big tech companies, Amazon announced in its last earnings report that its $26.3 billion in capital spending would represent a run rate for this year, equating to $105 billion in investments. And while we'll focus on where Amazon could be spending its money in this video, it's just a fraction of the estimated $1 trillion the 5 hyperscalers could spend through 2027, according to JP Morgan. Google parent Alphabet used its own report to announce a $75 billion spending spree. Meta Platforms talked up its $65 billion plans for the year, and Microsoft expects to reach $94 billion in spending, all just this year. In fact, big tech is spending so much money on artificial intelligence, you kind of wonder if management isn't just asking AI how much it should spend. I want to get started on our list of stocks to watch, along with where to look for this spending to boost the market, but let me know in the comments if you want to see where the stocks to buy for these other tech company plans. First up here is Astera Labs, ticker ALAB, up 70% since its IPO last year, and 2 big reasons it could be getting a chunk of that Amazon spending. First here, because the e-commerce giant is already an investor and a big supporter of Astera, holding over 277,000 shares of the company, worth $25 million. That's from the company's 13F filing, a required filing with the government that shows where the big money players are putting their investments. We're going to see that play out in other stocks on this list here. Amazon investing in the companies that align with its growth and where it could be spending its money. That means the company's 13F filing with the SEC showing where these investments are is like getting inside information into the theme. Basically, using these 13F filings from companies is like legal insider trading, except instead of handcuffs, you get stock picks, so I'm going to link to a video in the description showing you how to use them. The other clue that Astera is in line to get this Amazon money, and Nation, if there is one thing you get from this video, it is right here. It is in the research pointing us to these stocks. First, we start with Amazon CEO comments during the 4th quarter earnings report, saying, "We could be growing faster were it not for some of the constraints on capacity." Here, CEO Jassy is echoing comments by Microsoft the week before, and right here telling you that the big tech hyperscalers spending that $1 trillion through 2027, their growth depends on how many data centers they can build, and they're going to be going all out in building them. Now, we already knew that, but combining it with another article from last year and recent research I've been doing, we also see that it's not just data centers. The bigger problem, the biggest supply constraint coming is in data center networking, the routers and the switches that direct all that data traffic into the center. Nation, this is how you find those biggest opportunities in the market, putting the different articles, the different research, different pieces of the puzzle together to that bigger picture and something nobody is seeing. It's what I did for more than a decade as an analyst, and it is the only way you will beat this market. That market for networking infrastructure, the biggest supply crunch coming to data centers, is a market expected to grow more than 14% a year to $119 billion by 2023, according to Straits Research. And I think that forecast is grossly underestimated. So putting these 2 pieces of research together, and we know that a big chunk of that $105 billion in spending is likely to go into networking equipment within data centers, upgrading the infrastructure for data processing and storage. And so that's where Astera Labs comes in, not only as an investment in Amazon's portfolio, but as a leader in the networking and connectivity need. The company offers connectivity and networking solutions, which, while so far has gone under the radar in that AI boom, could be the next big bottleneck in artificial intelligence. That's because the immense amount of data and processing going on in these AI models is going to stress the current system for connectivity and networking, with only companies like Astera built specifically for those higher demands in AI able to provide the solutions. Revenue is expected to grow 70% this year to $675 million, and that's an upgrade of $60 million higher from looking at this stock in last November, with earnings already positive and expected to $1.26 per share. But this is still a tiny company on its potential. Well, tiny until you consider the valuation. Even on that expected revenue and earnings, shares are trading for 22 times sales and 71 times on a price-to-earnings basis. That's quite a bit lower than the current valuation multiples you see here, and especially where it's traded at in the past, so I wouldn't call it too expensive if it can keep on that growth and really leverage that data center boom. We're just getting started on our list of stocks to buy, but if you've ever wondered what's in my portfolio, or just want to see the stocks I'm buying, you can now by joining me on the Blossom Social Investing app. The app was created by investors and for investors. I just started using it last year and love it for getting those ideas and sharing my own portfolio. Now, this isn't just another investing app. You can connect your brokerage accounts or just input your portfolio to track all your stocks in one place. You're going to see insights like portfolio percentages and average dividend yield across the entire group, You'll also be able to join more than 200,000 investors in the social feed to see what everyone else is talking about. I've shared my portfolio on the app and it's totally free to download, so look for the special invite link I'll leave in the description and check that out. Back to our list, and one that could have a surprise into Amazon's spending, Monolithic Power Systems, ticker MPWR. First here, we have to step back and look at another major source of spending for Amazon for its own custom hardware, and specifically building its own AI chip Trainium. As much as I love shares of AMD right now, the only option in AI semiconductors is really NVIDIA, proven with its 90% of the market share for next-gen AI chips. And if you think of semiconductors or the chips as those brains of a data center, you understand how critical these are. That means the hyperscaler buyers are all trying to break that dominance by developing their own chips, and Amazon announced a major breakthrough last year in its Project Rainier supercomputer, powered by the Trainium chip. The chip purpose-built for AI isn't quite a match for NVIDIA's Blackwell yet, but operates on a stunning 1.3 petaflops on 8-bit precision and has the kind of high bandwidth memory needed for training those large AI models. The market for AI semiconductors is already at $117 billion and expected to grow to $193 billion by the end of 2027. That is almost $200 billion companies are going to need to pay NVIDIA unless they can break that dependence. So developing its own custom hardware is going to be a big priority for Amazon. Now, most of that $105 billion will go into building out those data centers, but tens of billions are also going to be going into developing Trainium. And that is where MPWR might come in. The company plays a crucial role in the AI chip industry from behind the scenes as a power management leader. AI chips require efficient, high-power delivery to function at peak performance, and MPWR specializes in the kind of solutions that ensure that stable and efficient energy flow to the processors. The company's competitive advantage is in its integrated power modules that offer higher efficiency and density than traditional solutions, making them essential for AI accelerators. Now, it's already got strong partnerships with leading chip companies like NVIDIA and AMD, and rumors are that it's working with Amazon for its Trainium as well. So again here, putting different pieces of the puzzle together. On its earnings call, Amazon noted that it's been back and forth with manufacturing partners to produce a lot more Trainium chips, matching that with what Monolithic said on its last call, that a customer with its Tensor processing unit was ramping up, led one analyst to believe that MPWR is a big supplier to Amazon. Now, I would never recommend a stock just on a rumor, but growth and other fundamentals for MPWR are where we want them to be as well. Revenue was up at 33% annual pace the 3 years to 2023, and while growth this year is expected at just 18% to $2.6 billion, it is still a very strong trend for a relatively small company. Even better though, shares aren't as expensive as some of the others on the space, trading at 15 times sales, or just 12.6 times this year's expected sales. And this is a company with a 26% operating margin, which is very strong profitability. So here, even if we don't see a surprise pop in MPWR revenue from Amazon, the company still fits in this bigger picture AI growth theme and will do well. While it doesn't already have the Amazon investment in its shares like Astera Labs, Arista Networks, ticker ANET, also wins in that networking infrastructure theme. Again, I've been covering this giant opportunity in networking stocks a lot lately, and it plays right into Amazon's spending needs. For those data centers to work, data held in storage or coming in through users has to be transferred to the server processors and then returned to storage or out in the cloud. That networking equipment like switches and routers is the plumbing through which this data moves, and right now the nation's pipes are way too small. BNP Paribas expects sales of data center switches, which route that traffic, to double over the next few years, and for sales of back-end switches to quadruple. Capital spending on switches alone is expected to grow nearly 8 times from $127 million last year to $1 billion by 2027. And all those Amazon data centers that run AWS are all going to need that money spent on networking. I'll link to a previous video describing all this in the description below, but Arista is the data center switching leader, specializing in the kind of high-speed, low-latency networking that AI data centers must have. Its EOS software is a key differentiator, offering better programmability, automation, and scalability compared to Cisco's legacy systems. Its single unified operating system means better reliability, automation, and scalability across all of ANET's products. And its Cloud Vision provides real-time telemetry, security enforcement, and analytics for predictive and self-healing networks. Proof is in the growth here, with 35% annualized growth in revenue over the 3 years through 2023, an expected 20% pace last year and for 2025 to $8.3 billion. I believe that re-accelerates as we see this data center boom get started. Shares of Broadcom Inc., ticker AVGO, also made that networking equipment video, but Broadcom goes further into the entire data center ecosystem. And that's going to mean big money, because when CEO Jassy was talking about those constraints on capacity, it's across the entire data center. The company's cloud services product, Amazon Web Services, or AWS, operates in those data centers, and One look at the financials shows you how important this is. AWS is more than 17.5% of total revenue and grew at 19% last year. Now that growth is exactly double the 9.5% revenue growth from the rest of the company's segments. More though, AWS operates at a giant 37% operating profitability compared to the ridiculously tight 5.4% profitability the rest of the company operates on. This all means the company's growth engine and its cash machine is limited by how fast it can put up these new data centers, so you better believe it's putting them up as fast as possible, no matter what the cost. Not only does Broadcom dominate in that networking theme with its Ethernet switches and network processors, the company supplies data storage solutions with its RAID and tri-mode controllers. Its ASICs and custom silicon support hyperscale AI workloads, and a hardware-based security is available through its TPM chips. The fundamentals and valuation for Broadcom are similar to what we saw with Arista, with its 23% annual growth to $51.5 billion last year, slower than with ANET, but with the same 19% expected growth this year to $61.3 billion. Shares here are also expensive, like pretty much everything in the AI space right now, but even at 21 times on that price-to-sales valuation, if the company keeps up that 20% sales growth, their shares will keep running. Amazon already owns almost 20% of this next stock and could buy the rest of the company with less than 2% of its planned spending. But you'll notice that most of these stocks revolve around that AI and data center theme. Don't miss the video in the corner here for the one AI stock I'm buying right now, the data center stock that is trading at a 40% discount. Air Transport Group, ticker ATSG, is Amazon's largest ownership stake with 12.7 million shares worth almost $280 million. And a 20% stake in the company. And here, even on a 55% jump in the shares over the last year, Amazon could buy the rest of this $1.5 billion company for pocket change compared with its full-year spending. Air Transport offers a complete air leasing and support service to blue-chip companies in both passenger and freight, leasing aircraft, freight operations, maintenance, and servicing leases. This is a strategic investment for Amazon. With its major controlling interest in ATSG, Amazon has a partner in its freight delivery, with Air Transport providing and leasing planes to the company. And again, while the majority of Amazon's $105 billion spending will go to driving that AI growth, it just can't ignore the core e-commerce business. Online stores and third-party sellers account for $89 billion in revenue and nearly two-thirds total sales for the company. And for that reason, Amazon has to always be looking for ways to improve that fulfillment and transportation. And that's where ATSG comes in, whether as a standalone partner or possibly as an acquisition by Amazon. Greater control of the company could help Amazon lower some of those costs and drive higher profitability. ATSG isn't a fast-growing company, with revenue down slightly last year and expected up just 4% this year to $2.1 billion in sales. It's also not terrifically cheap at about 20 times expected earnings, though this one does have very dependable cash flow with its Amazon tie-up. So again, this could be a takeover target by Amazon in the future, so there is some upside potential and revenue growth is dependable. But it's not the kind of growth stock others on the list could be. Join me on the Blossom Investing app with a special invite link in the description below, or click on the video to the right to see the one AI stock I'm buying above all the rest. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.